Hey everybody, welcome to the morning market briefing, Thursday, May 26, 2022. Hope you're doing well. Lots to talk about. We are feverishly refreshing our screen as we wait for the Q1 GDP revision. Tom, we last reported at minus 1.4%. The expectation is for a slightly higher revision to minus 1.3%. I took the under.
Well, you would be correct. So the actual GDP number came in at negative 1.5%. So we're actually, despite the expectation for a revision up, we actually revised down. Ben's looking at the numbers. This is where Ben's supposed to jump in with the color commentary.
So not a better number. I don't know that I would classify that number necessarily as a surprise, though. When we started the call, Dow futures, S&P futures were up about 0.5%. That's still where we are. I'm not really seeing any movement in rates in the last minute. Been scrolling through the data. Thematically, I think there's nothing else, just kind of reaffirms the expectation today. We might technically be in the middle of a recession if second quarter GDP is looking this way. And I think it is. I think second quarter GDP, I would be very surprised if it's positive.
Yeah, I would agree. I think there's, if we're already revising Q1 down, we're going to have to hit quite a high hurdle to be growing in the second quarter. And given the numbers we've seen on a lot of these retail stores over the last couple of weeks, I think, the expectation is probably that we are going to be in a recession once we hit the GDP number for Q2.
And we did get positive at the same time initial jobless claims. The estimate was for 215,000. Last reading was 218. We actually fell to 210,000. We talked about that last week as a data point that we probably need to start paying attention to once again. But that's positive data. Ben, I don't know if you have much that you've been able to take away in the last 2 minutes of Tom and I pretending to stall. But any takeaways, or do we want to just keep moving and come back?
So the big negative revision. So you actually had positive revision on the services side of the economy. But then it was more than offset by negative revisions on the investment side. And that was really driven by inventories. So negative revisions on inventories in the quarter, which is actually fairly surprising given the fact that we're seeing all those markdowns by retailers in April. So inventory basically didn't build as much as we thought in Q1. And so that dragged on to GDP. And so that was the primary driver of the negative revision. Overall, I don't think this really changes anything other than solidifies what we already do.
Yeah, another data point we also got was the revision on core PCE, which was actually slightly down. So it was 5.2 was the last number. We came in at 5.1 on the revised numbers. So that's, negligible. It's 10 basis points, but it is, a slight indicator that perhaps inflation is ticking down.
But the thing is that
tiny
that's a Q1 number.
Yeah.
Which means that the Q2 number is going to be even higher than that.
Yeah.
So it's just going to, I feel like it's going to look worse.
Yeah, it definitely is. Yeah. So if we revise down now, we get a big number, it's going to be a net negative, but at least it's slightly positive.
Yeah. There's movement.
There's silver lining, as they say.
Yeah. Snowflake. Everybody loves when millennials talk about other snowflakes, but Snowflake down 13%. File this among the companies that I don't really understand what they do. That's a distinguishing factor. I know they do cloud storage and analytics and that kind of thing. I feel like there's a million companies that do that, but they saw revenue growth slow pretty significantly to more conservative guidance, still expecting revenue growth. That's still pretty robust, just not where they were. Stock getting hit pretty hard. Ben, any surprise there?
Not really. I think the biggest thing with Snowflake is that, so this is a $45 billion company, or was a $45 billion company that's doing about $1 billion or $2 billion in revenue. They want to be at $10 billion by the end of the decade, which would obviously be phenomenal growth to grow about $1 billion a year from such a low base, if you look at that on a percentage basis. But essentially what they're seeing is that they provide these cloud services on a consumption basis to consumer-facing cloud companies. So think companies like Amazon. Amazon is a consumer-facing cloud company. The problem is in April, there was weakness in growth on, especially among those customers, especially among the large consumer-facing cloud customers, they say things have improved in the last couple of weeks here in May, but they're taking down revenue guidance just out of caution. Overall, I think that this is a concern because what we're learning is a lot of the recurring revenue at these recurring revenue software companies isn't as locked in as people thought. And I think that's the big difference from what people were thinking in maybe a year ago when they said that this revenue is extremely durable. It's going to keep going no matter what. It's going to be robust to the cycle. What we're finding out that's not so robust to the cycle because it's dependent on their customers paying them. And if the customer is impacted by a weak consumer cycle, Snowflake and others are impacted by a weak consumer cycle.
We also got earnings from Nvidia in kind of an interesting, I guess, market pricing point. Nvidia was down about 10% right when they released earnings after hours yesterday. Right now, stock down 4.5%. So it certainly recovered a good bit. Notably, stock was up more than 5% yesterday. So although we're talking about it being down, it's higher than it was 24 hours ago. But Nvidia saw slowing in gaming. Unsurprisingly, a slowdown in hiring is anticipated. Ben, thematically, I think we were all kind of on the fence about, what this quarter is going to look like for Nvidia. Any surprises there thematically in terms of just how this performed? I mean, we're obviously late in the earnings cycle. They're a little bit off cycle and when they report things, but I do take it a little bit as a positive that things maybe weren't all that rosy and the stock sold down 10% and actually recovered some.
Yeah, I think the biggest question mark with Nvidia is gaming slowed down, and gaming is expected to continue to slow down. They're saying that the China's lockdowns are negatively impacting that from a demand perspective. They say that the Chinese have a lot more things to worry about than getting the new gaming chip. My view is a little bit more nuanced. This is a quarter of their business. My concern with that is that Chinese economy is in a recession. People don't have the money to buy these high-powered gaming chips. And I think that we're seeing a gaming downturn. The positive for Nvidia is that they're a lot more robust to that this time around than when last gaming cycle in 2018. Last gaming cycle in 2018, between crypto mining and gaming, you were talking about 65% of their business was related to that. Today, it's 45. Data center was 25% of their business back then. Today, it's 40. Today, data center is 45. So we've seen an evening out in terms of the robustness of that business model. The data center business is continuing to perform extremely well because people need that processing power. So I expect that Nvidia in this downturn is going to be a little bit more robust than it was in the prior downturn, but it's still a downturn. And for that reason, I think that we're going to be at best in a bit of a holding pattern for Nvidia over the next number of months. I would use that time over the next 6-9 months to begin accumulating positions and gradually building positions in the company, because I do think this is a big winner long term.
Interesting. We talked primarily about public markets, but Sequoia Capital, a heavy player in the venture capital space, had a Zoom call yesterday. Pretty interesting in terms of kind of prepping folks to get ready to cut costs, get leaner. Ben, it seems like this is a natural progression. I mean, we're seeing massive companies all over the board have to do this. It's not surprising to think that, hey, these smaller venture-based investors are going to have to kind of face the same types of consequences. How do you think that plays out, and what would your concern be for kind of Silicon Valley and just the venture space at large?
The venture capital money is not flowing as easily as it was. I would not want to be one of these kind of early stage companies right now that's relying on venture capital funding, because now you're beginning to see the negatives of these benevolent financiers. Sequoia Capital coming to you and saying, look, you got to figure out a way to cut expenses. Right? Man, I'm changing the world. I'm delivering this growth. And then your financial backer comes to you and says, cut expenses, figure it out, and heads may have to roll. And that's what we're seeing in Silicon Valley right now. Sequoia Capital is kind of leading that. They said, do the cuts. It doesn't mean you have to pull the trigger right now, but that you're ready to do it in the next 30 days if needed. So I think this is a theme that we continue to need to follow. It follows the Snowflake earnings. It follows the Nvidia earnings. Tech is definitely struggling right now.
Yeah, and along those lines, to an extent, we've got so many topics here, so I'm just going to run through this one. But Apple down about 1%. They're going to keep iPhone production essentially flat in 2022 relative to 2021. That doesn't mean revenue couldn't grow. They obviously have other services. They also will probably, I would assume, have some pricing power, so prices could go up. But they're asking suppliers to assemble about 220 million iPhones. Which is pretty much in line with where they were last year. Previously, forecasts were expecting 240 million iPhones. So iPhone 14 production starting slower, China lockdowns impacting that. All the issues that we've been talking thematically having an impact there, and Apple stock taking a little bit of a ding for that. Meanwhile, we have apparel actually looking like it's holding up a little bit better. Surprisingly, I mean, very high on the list of companies I would now expect to be doing well right now. Macy's up 15% on a boosted outlook. Dollar stores back in vogue, which maybe is a little bit less surprising. But we saw Dollar General rise 11%, Dollar Tree up 16%. Kind of interesting pockets of the market doing well right now, in my opinion.
It's a barbell economy where you got some people, especially at the high end, who were buying a lot of stuff on Amazon before. They're going out to stores and they're buying high price luxury goods at Macy's and Nordstrom's, which is helping those gross margins, et cetera. And at the low end, people are mixing down. They're going to more Dollar General and Dollar Tree. And by the way, they don't care about spending $1 or $1.25. Dollar Tree just raised its prices from $1 to $1.25 because they just want a cheap product. And so we're starting to see a little bit more traffic in those stores, and those stores are doing well as a result.
I feel like Dollar Tree should rebrand as the fifth quarter.
Yeah.
Nice. Oh, maybe just overtime. Costco reporting tonight. We've got obviously a good read on what revenue was. Going to be paying attention to the costs, especially on the freight side. I'm sure we'll talk about that at length tomorrow morning. But Tom, we did get Fed minutes yesterday. They're planning 50 bip hikes for the next two meetings. They referred to a potential need for a restrictive monetary policy. What's your takeaway, Matt? I didn't feel like there was anything all that noteworthy, but the market really responded.
Yeah, we missed the release. We were in a meeting in Mitchell, Georgia, the jewel of Glasscock County, aka God's country. But I went through it last night and reread it again this morning. There wasn't a ton of takeaways that I thought were particularly mind-blowing, but I think the idea that the Fed is going to continue to raise rates aggressively for the foreseeable future, I think they kind of took that off the table. They basically said, hey, we're definitely locking in for 50 bip rate hikes for the next two meetings. And then after that, we're going to be data dependent, which is very much in line with what Raphael Bostic said earlier this week, which is that there's a potential for a pause in September. If you look at the way futures are structured right now, we're basically locking in a one rate hike per meeting through the end of the year after July. So I think the idea there is that they're going to get, I would call it medium aggressive here for the next 2 months, see where inflation is, see if there's any change there. And if it's more aggressive, if more aggressive policy is needed, then they're going to up the number of rate hikes. But they're basically saying we're doing 2 and then 1 up from there until we get to, above a neutral rate, which would play into the quote restrictive monetary policy. So they're basically going from taking the foot off the accelerator, and then they're going to put the foot on the brake. And so we're going to be above what they would call the neutral rate in order to slow economic activity and crimp demand. So it's nothing that I think is mind blowing for everybody. I think everybody, worries the Fed is not going to raise rates enough, so at least for the short term, they're continuing to commit to relatively aggressive moves, historically speaking, for the next few months, and then kind of see where they are from there. And so I think that's a net positive for the market. I think there's so much confusion as to whether the Fed is going to be aggressive, if they're not going to be aggressive. Do they have the cojones to slow the economy enough, and bring the markets down enough to get inflation under control, which, ultimately would be a net positive. So that's really the big takeaway there, is that, they're basically saying we're going hard in the paint for the next 10 minutes, and then we're going to see what the score is.
Ben, you're kind of our chief European correspondent. The interesting thing to me over the last 2 years has been just watching how different central bankers kind of respond to different economic challenges and conditions. What's the UK doing right now? It seems like they're just throwing money at the problem.
Yeah, they're throwing money at the problem. They're giving a one-off £650 payment to 8 million low-income families. They're going to give a one-off £300 payment to 8 million pensioners. They're also giving 400 pounds of discounts on every energy bills for every household. And they're going to pay for this partly with a 25% windfall tax on the profits of oil and gas companies. This is designed to be temporary and targeted. That will raise about 5 billion pounds, but the total cost of the package is going to be about 37 billion pounds. They did say that getting inflation under control may take time.
Well, yeah, if you keep dumping money in the system.
Yeah. And I think this is just an example of where people are right now, because on the fiscal side, so Chancellor of the Exchequer, Richie Sunak, he is
Sure. I think I might have hit the SAP button. Are we still in English here?
He is his mandate is to get reelected and help the conservatives get reelected and grow the economy. So he's trying to do that, whereas the central bank is trying to get price stability, and they're trying to do that, and they're kind of battling against each other. And then we're even seeing that in the United States too. So I mean, a lot of what they've talked about today are things that we've talked about in the United States. The United States hasn't done anything. The United States hasn't led on any of this stuff. They haven't really led on any of the direct payments or anything since March of 2020. A lot of it's been following. But I wouldn't be surprised to see President Biden look at some of these proposals and say, this makes some sense in the US. If the UK can do it, why can't we? And I think that's really where the implications come for us and for our investments and for our financial situation. So I would look at this as a potential model that politicians in the United States might use. I'm not saying they're going to use it, but this would be the early stage of maybe something that gets percolating in their minds.
Lots of M&A activity. And we can kind of run through these quickly. We got activities with Wendy's, Valvoline. We've talked a little bit about Broadcom buying VMware, and I mean, maybe most noteworthy, big miss by producer Hicks, not to play some JT, but Justin Timberlake sold his catalog to a Blackstone-backed fund. Hypnosis.
Yeah, I don't know.
It's Hypnosis with a G in there. Song manager. I don't know if that's a typo or if they're just trying to be cute. Yeah. But either way, lots of activity. I mean, I kind of think we're going to continue to see relatively elevated M&A, less through the lens of creating scale and more through the lens of kind of creative financial engineering at this time. Would you agree with that sentiment?
Yeah, I mean, I think there's a strategic rationale for all of these. Like if you look at Wendy's, the guy owns 20% of the company. If you own a company going into a recession, you want control, basically, and that's what they're going to do at Wendy's. Valvoline, it's already splitting up. Saudi Aramco wants to diversify. They're looking at that. Broadcom wants to grow and diversify away from semiconductors. So I think there is some, yes, the financial engineering pieces are there, but I think it's also strategic. It's about synergy and it's about control. The Justin Timberlake thing was interesting. The $100 million price tag seemed a bit low to me relative to some of the other things that we've seen. But Hypnosis, song management, they've purchased about $2 billion music rights already, and they only started in October. So
yeah,
they've really been aggressive.
We say this often, but if anybody wants to buy the rights to previously recorded versions of our Zoom calls, let us know. It'll be cheaper than 100 million, but maybe not much.
Otherwise, we're going to NFT it.
Yeah. Oh, now we're talking. More locally here, Savannah, the second largest U.S. Container port on the East Coast, is really seeing their backlog grow. They've got 19 vessels waiting to unload, up from kind of a normal level over the last year of 7. They had record performance in handling cargo in April, getting more and more ships kind of flowing this way.
Yeah, basically, people are saying, I don't want to even deal with Long Beach right now out on the West Coast. I don't want to deal with those ports. I'm going to take it through the Panama Canal. I'm going to go straight to Savannah, even Charleston as well. But Savannah is the second largest port over here. And you also save on freight costs, shipping stuff across the country with diesel prices where they are. So it makes a lot of sense, but Savannah is really bogged down right now. They're performing well, but they just have a lot of volume they need to process.
Awesome. Lots of content today. We're going to wrap it up there. We will be back tomorrow. We'll talk Costco earnings and other things. Hope y'all have a great day and talk to you soon.